In today's episode, I get the chance to talk to John Wright, who is now Global Head of Credit and a partner at Bain Capital Credit. John joined the firm in 2000, making him a lifer, one of the few managers of private equity and private credit that is still private itself. John and I had a wide-ranging discussion, but I'll steer you just a bit on CLOs, collateralized loan obligations. There are three camps in the CLO world, John says. Those who don't want to touch them because there's guilt by association with other structured products, those who will invest during a market dislocation, and those who have done the messy work to understand them and will always have CLOs in their portfolios. That kind of irrational behavior on the part of investors is what keeps these markets a good bet for the well-informed. As John says, because that last camp is small relative to the first two camps, the market's really inefficient and continues to produce opportunities. Some similar logic, or lack of logic, goes on in so many sectors of the market and is an enduring lesson for rational investors. One more thing before you listen. This episode is sponsored by Bain Capital Credit, but John didn't approve the questions beforehand or listen to the podcast before it was posted. Enjoy the conversation and let me know what you think. Well, John, thanks for doing this with me today. I'm really looking forward to our conversation.
Thank you very much for having me. Excited to be here.
It's going to be fun. So, you're a partner and global head of credit at Bain Capital at a time of peak popularity for private credit, one part of your mandate. But depending on who you talk to, it's also a time of peak worries and peak confusion. Even the definition of private credit isn't an agreed upon term, and would love to talk to you about that as well. But looking back to when you started at Bain Capital, I'm interested to know whether you would have been surprised if you had a glimpse of 2024 and what's actually happening in this asset class right now. But of course, before we get to that, I want you to set the stage and talk a bit about your own career and how you got to Bain Capital in the first place.
Sure. So I've had the good fortune of being at Bain Capital now for 24 years. So I started in 2000, and my career trajectory, as I left undergrad, I worked at a mutual fund company for a little less than a year. I knew I wanted to get into finance. I wanted to take on a lot of responsibility. I knew I had a lot to learn. And I was looking for an opportunity where I could take on responsibility. And when the opportunity came up at Bain Capital, it was a firm with a fantastic reputation, even back in 2000. But the role was not one that I was particularly excited about, frankly. It was a finance job, really an accounting job. Oh. And I was advised at the time by someone who knew better than I did that said, go work at this firm. It's a fantastic firm. A lot of doors will open for you. Sure enough, I started, and it was a great learning experience from day one. And I got exposure to a lot of people in a lot of different roles who were willing to spend time with me and teach me things I didn't know. And I took that role in the finance group and pretty quickly started working in the structured products group and focusing on building models and projections and working very closely with some great mentors for my career. And that evolved into us investing in different structured credit assets, which over time overlapped with our growth in the CLO business. And I eventually was selected to lead our CLO business. And over the last, I'd say, 7 or 8 years, I've had various leadership positions in the CLO business and in liquid credit. And for the last couple of years, I've been heading the credit group.
Got it. It's funny. So someone said to you, great firm, maybe not a great job, but work hard and something more interesting will come up.
Yeah, and to be fair, it wasn't that it wasn't a great job. It was a great job. It just wasn't exactly what I wanted to do. Right. I knew I wanted to be on the investing side. And I think a lot of people in this industry, it's difficult to transition from a job that's not an investing job into an investing job. And back then, the firm was growing a lot. There was a lot of responsibility that just needed to be handled and had people step up and say, I can do this and I will do this. And for that, I'm really grateful for the opportunity.
Yeah. You're practically a Bain lifer.
Yes.
And you've been in this area for, quite a while. Talk about what some of the biggest changes, have been during that time period.
Sure. You had asked what I have expected that the firm looks like
it
does
today. I'm
getting
back to that, but okay.
And the short answer is no. As I think about the firm back in 2000, both in terms of scope, diversity of strategies, number of people at the firm, the global nature of what the firm looks like today relative to back then. Even in the early 2000s, while we were a separate legal company, there was still a lot of overlap with folks who had worked at Bain & Company, and that consulting heritage was still very common. It was still very much kind of a PE-centric firm with credit as a new growth area. And as you think about the profile of the firm today, PE is still the largest part of our business, but credit is second in terms of assets. And to take a step back and to see our second largest office outside of the Boston headquarters is actually London. How international the firm has become, and that growth has been true in Europe, it's been true in Asia. And so both the geographic expansion as well as the diversity of strategies that we have. We have 13 strategies across things that range everything from private equity and credit to life sciences and venture. And so it really is a broad spectrum of strategies today.
And you wouldn't have really kind of seen that. It seemed more narrow to you, or?
In the early days, yes.
Yeah. No, that's so interesting to see that whole arc. A lot of people say to me, well, private credit, it's an asset class since the global financial crisis, right? And I do think that's a bit of a myth. I mean, obviously, it might have been called something else, or it might have sat in a different place, but those transactions were happening long before that. Mm-hmm. What other big changes do you think have taken place besides sheer growth?
Sure. Well, if you look at today, the definition of private credit includes a lot of things. As you go back in time, traditionally, private credit was what is now called direct lending. And it was really lending to companies that were too small to access the bank market or the syndicated market. And today, private credit really encompasses a lot of private lending, including direct lending, including private lending to larger companies, including asset-backed finance and various other forms of lending. But the original form of private credit was middle market, corporate, direct lending.
Okay. And these were companies that they were just too small for a bank to be able to do that kind of financing.
Correct.
Yeah. In the early days, I think Jonathan Levine might have said something like, you can't just credit pick your way to alpha anymore. In those early days, I'm sure it's not to say it was easier, but talk about that a little bit.
As I think about the credit markets in the early 2000s, the idea of being an institutional investor with a heritage in consulting and private equity and really understanding businesses, I think we came to a market that at that time was very heavily dominated by banks. And so you're competing with credit underwriters, generally buy and hold investors. And so I do think there was a very significant opportunity in both traded credit markets as well as direct lending to separate yourself, to define alpha as credit selection alone. What I think has changed over time as the market has evolved, and this is clearly true on the syndicated side, is one, the market's much bigger. The market is much more liquid. A lot more of the participants are trading credit. And so the size of company is larger, but also it's more competitive. So it is harder to differentiate solely on the basis of credit selection because a lot more of the investors are doing that deep level of diligence. Now, as we look at the market today, to contrast that competitiveness, I think the opportunity exists today to deliver value through asset allocation. Now, that can be asset allocation within an asset class, either identifying quality differences, that can be across different pockets of the credit market. So you can talk about traded credit, private credit, structured credit. And there are a lot of really compelling opportunities to be able to allocate across these sub-markets when the value metrics show you that they're attractive. And that's where I feel like the competition is not as intense relative to just focusing on one single part of the credit market.
Why is the competition not as intense in that?
I think fewer of the pools of capital have the flexibility to move between sub-markets within credit. And that's where we have strategies that have the flexibility to do that. And because these pricing differences can exist for short periods of time, it helps that we have that ability to reallocate as we see the opportunity, as opposed to having to go back to our investors and say, hey, we want to allocate money to this sub-market. And so I think having that flexibility of capital is really an advantage in terms of exploiting those asset allocation opportunities.
Yeah. It is true that the industry has gotten so specialized in private equity and in private credit, maybe even real estate. But investors must like that, because then you don't have that hammer to a nail thing, right?
Yes. I think that's right. I think the other challenge is some investors that are large have certain buckets that they put investments into. And so if a mandate is too broad, it doesn't fit neatly into one of their buckets, they may not be comfortable with it. And that's kind of the structural reason why many of these, if you're a hammer, everything looks like a nail, strategies exist.
Yeah. So asset allocation, but that seems like a very different skill set that your team needs to have. I mean, obviously they're still picking credits. Asset allocation, is it quantitative? I mean, how does that work?
It's both. I think one of the advantages that we have now, and it's also a change that's happened over the course of the last 25 years, is there's a lot of data available that we can analyze. And as you think about how technology has evolved and our ability to leverage the technology that we have today versus what's existed, there are a lot of quantitative things that we can do to screen opportunities. I would say we as investors at our core are very much fundamental investors. And so we will use these quantitative screens to bubble up opportunities. But it's at that point that it signals an opportunity that we then dig into and fundamentally say, do we agree this is the right opportunity to dig into? So it's really marrying those two things, which is where we think we can add the most value.
Right, right. I bet a lot of people don't really imagine that. I mean, these are areas that are they're like the epitome of active management and really looking at one thing at a time, which I guess you have to do after that quantitative research is done or screen.
Yes, and at the end of the day, I don't want to give you the impression that we don't think credit selection matters. It absolutely matters.
Right.
It matters a lot. And that, I think, is table stakes to be a competitive manager.
Right.
And that's a skill set that we've honed over the course of 25 years.
Yeah.
Marrying that with asset allocation is really where we think the best opportunities exist.
Right. So interest rates, right? I mean, they've been on the decline for 40 years. And only recently have they really risen pretty dramatically. Talk about what that's meant, for your business and the businesses that you lend to and what you're concerned about.
To start with, the process of resetting interest rates, I think across markets has been one that has been very painful, but I actually think is a very positive development from the standpoint of being a lender and being able to generate a real yield for investors without having all of that needing to come from spread. And so starting at a place where you see investors thinking about both fixed income and credit opportunities as a core allocation because now they can really generate a yield without having to take as much risk as they might otherwise had to. So I view it very much as a positive development and one that, if anything, you had talked about the golden age of credit or private credit, I think has made our asset class more competitive with alternatives because of the fact that you can generate a higher yield.
Okay. But, at the same time, like part of the value proposition when the rates were so low was, hey, here's this illiquidity premium and, go beyond, investment grade and high yield. But you're saying the value proposition is even more so to a certain extent now that rates are normal, if we can call them normal.
Yeah, absolutely. I think what our investors want us to do for them is find opportunities that we believe generate more return, either because they're complex, because they're less liquid, because they're not as well understood. And the base rate being higher gives us a higher foundation as a starting point. Obviously, the spread then compensates us for all those other risks that we're getting comfortable with.
Right, right. And so do investors kind of understand that, or do they come to you and say, oh, all these companies have to refinance and all these other things, worrying about the health of what they've already invested in?
Yeah, they do both. And, our responsibility and what we're looking to do with these investors is making sure that they're getting a good return on their capital and that we're managing it in a way that we're not investing in things that are too risky where they're going to have some impairment on their investment. And so, of course, they're concerned about risk, but also, I think, excited about the yield opportunity. And that's something that we communicate with investors all the time with, and we think, presents a good opportunity from here as well as some existing portfolios.
Right. So over the last couple of years, the broadly syndicated market hasn't quite worked, right, the way it had in previous years, and larger companies tapped private credit, which I think is kind of a good thing, right? It's an alternative form of financing instead of being completely locked out. Private credit shops, stepped up. Maybe you have a different view. But talk a little bit about how we got to that point in the markets and what you think has kind of happened and what investors should think about.
So if we go back to what we were talking about originally as what private credit was, it was lending to companies that were too small to access the broadly syndicated market. What we've seen is a number of firms have raised a lot of money for private credit or for direct lending. They've focused on doing larger and larger deals. And so that puts them in direct competition with the broadly syndicated market. Now, that phenomenon happened to overlap with this move in interest rates, this repricing and risk. And so banks in 2022 and 2023 were not really willing to underwrite credit for the broadly syndicated market the way they normally do. And that was a great opportunity for direct lenders to step in and give borrowers certainty of execution, give them an alternative funding source. What's been interesting this year is as that broadly syndicated market recovers, as banks are now underwriting credit, they're now really in direct competition. And that's where I think borrowers are looking at where can they get the best financing package, the best economics, the best document. And so I think that competitive dynamic is good for borrowers. I'm not sure it's good for either of the lenders in that you have a new competitive force in terms of the economics that you're able to get as a lender. But it is something that I think is a recent enough phenomenon that it hasn't really been tested to see what's the steady state of market share that goes to private credit versus broadly syndicated.
What do you expect?
I think that in most normalized markets, borrowers that fit the box or the profile that broadly syndicated arrangers are willing to underwrite, they're going to end up in the broadly syndicated market. I think direct lenders will operate outside of that box, either companies that need a little more leverage, that maybe need coupon flexibility, that need something different than what the broadly syndicated market offers them. That's where private credit and direct lenders will be more competitive in the mega cap space.
Okay.
I think it's important to keep in mind that core middle market still operates separate from the broadly syndicated market, and that's where our business is most active.
And so why have you remained focused on middle market companies?
Sure. I think one of the key driving forces of us maintaining our presence in that core middle market goes back to some of the principles of the firm and the fact that we're a private partnership. And so one of the unique things about Bain Capital is, as a private partnership, we're owned by the partners. There's no external ownership of the equity. We really have an investor-led mentality about everything we do. And so rather than focusing on where can we be the biggest or the most scaled player, we focused on where do we think we can generate the best returns. On the direct lending side, that's always been in the core middle market. We're the majority lender on the majority of direct lending loans that we do. We have covenants on the majority of the loans that we do. We feel like we have very good connectivity with the sponsors in that part of the market. And so for us, we feel like we're getting a better return opportunity in that core middle market. We don't have public shareholders that are asking us what our AUM growth is or what our FRE is going to be. And so keeping that investor return focus as front and center to everything that we do strategically, that's really determined where we are in that market segmentation and why we've stayed in that core middle market.
Yeah. I mean, talk more about that. I find it really fascinating that, you have remained private. I mean, obviously, a lot of firms, private equity and other big asset managers are public. And, you have to please shareholders. And institutional investors have told me over the years, right, like, that scares me because they're going to become asset gatherers. But at the same time, some of those firms have done well. But it does just make intuitive sense that if you're private, you're going to operate differently. But tell me more about how that plays out in terms of attracting talent, in terms of conversations with investors.
Sure. I think the single biggest differentiator for us, we think, in staying private is it enables us to have a long-term view on just about everything that we do. Meaning it enables us to take a long-term view on return opportunities and investments. It enables us to take a long-term view on talent. And it really enables us to say to our external investors, we are focused on delivering returns in your strategies, and that's our one and sole focus. And so we don't have to think about short-term earnings. We don't have to think about, as I said, AUM or FRE growth and any of that kind of short-term focused, public-driven things that you need to report on. And so that enables us to say to people that we're looking to hire, we want to bring you in and we're going to take a long-term view on your career. As I look at the credit business, we have 23 partners, which on average have worked together at Bain Capital for 15 years. I think that's really a statement about how long-term we tend to take a view of people and their development in their career at the firm. And so I think all of that goes back to the core of being investor-led and maintaining the private partnership.
Yeah. Does it ever make it hard to, attract people because they want, to have stock as part of their compensation, or?
Yeah, I think there is a visibility question where being public, there's just more opportunity for you to be visible than if you're private.
Yeah.
But I think that's something that kind of aligns with our culture again. We tend to be a little more, I don't know if reserved is the right word, but a little more measured in terms of how we think about our exposure.
Yeah. I also think it's interesting that you're private and then you're investing, obviously, in private companies. I don't know if that gives you, more insight, but, obviously companies are staying private longer and have no real urgency to go public. But I find that kind of relationship interesting. I don't know if it adds anything to your analysis or.
Yeah, I've heard someone else say that basically if you think about the private equity business model, that part of the value of private equity is that you can do things in companies if they're privately held that you couldn't do if they were publicly traded. Because you can do things over a longer horizon, you don't have the same visibility around short-term performance. And so by the same thesis. It's
Yeah.
better as the manager of those companies or as the investor in those companies to also be private. So I think there is certainly an alignment there around
Yeah.
that thesis on the investing strategy as well as how we're structured as an organization.
Yeah, yeah. I mean, it's funny because there's so many private companies, but on the asset management side, there aren't quite as many. I don't know the exact numbers.
Yeah, I think traditional asset management is more, well, I think you could look at differences in growth trajectories around traditional asset management versus alternative firms. But yeah, it's more concentrated. I think that's fair.
Yeah. Well, so talk about collateralized loan obligations. How do investors view CLOs? And you have to kind of define CLOs just for the few people out there in this world who don't get that.
Sure. So a CLO is basically a company that the assets of the company are a pool of leverage loans, and the liabilities of the company are a capital structure that uses securitization that has senior and junior debt as well as equity. And the way a CLO works is you lend money at a higher rate than you borrow money, and the difference between those two things is what generates the return to the equity. I think investors with CLOs fall into a couple of camps. I think one camp is it starts with C, ends with an O. There's guilt by association around structured products that didn't do well during the financial crisis. There's too much risk for me to take this to my investment committee.
Even
no
15
thanks.
years later.
Even 15 years later, despite the fact that CLOs actually have a very good track record and have survived many cycles. That's one camp of investors. I think another camp of investors looks at CLOs and sees that if you look at CLO debt or CLO equity, it does trade in the secondary market. There's some liquidity, but it can live through periods of pretty steep volatility. And the second group of investors might say, I understand this product, I think it's interesting, but I'm only going to allocate to it when I see this window of opportunity where they trade off a lot and I see it as a really cheap opportunity. And then the third camp of investors, I would say, is those investors who have gotten their proverbial hands dirty in learning what the product is and understanding the stability of the financing, look at historical performance, understand how it behaves in different markets, and actually really like it as a core credit or fixed income allocation. And that can be true for debt or for equity. And because that last camp is small relative to the first two camps, the market's really inefficient and continues to produce opportunities that we feel like we can take advantage of, both because we have expertise on the underlying assets, but also because we have expertise on the structure. And at this point, we now have a 25-year history of investing in and issuing CLOs with good outcomes. And so it's a product we like a lot. It's not a very well understood product amongst the investor community. That's part of what keeps it really interesting.
But they've had so much time to learn what it is. And here we are, like you're publicly saying, keep hating it because that makes it inefficient and, we can take advantage of that. Why do you think it remains inefficient? I mean, not only this, but lots of markets.
I think there are structural limitations for investors to want to do something new or different or take a risk that they haven't historically allocated to. And I think if you look at the profile of different types of institutions, if you work at a firm where the focus is going to be on principal protection, do no harm, the idea of trying to get something approved that's perceived as risky or may have a difficult history to explain, there's just not really a motivation to go get involved in that asset class. And I think that exists in certain investor communities, but that's part of what drives the opportunity in those communities where investors are willing to do the work and understand it.
Right, right. So there's still a premium for you to understand that complexity.
And I'll share an anecdote. I mean, there was the insurance community. If you look at the regulator for the insurance community right now, they're looking at increasing the capital requirements for different CLO tranches and have put out, public statements that they're doing that in part because of the history of CLOs and challenges that CLOs have had in the past. And if you actually look at the history, they haven't had challenges. They haven't had impairments. They have a very clean impairment track record. And so, again, I think it's a bit structural in terms of that misunderstanding about the performance of CLOs versus some other structured products.
Right, and certainly the regulator introduces another wild card.
Yes.
Yeah. When I was speaking at a conference recently, investors were a little cautious about private credit because of potential regulatory changes. And it was the first time in a while that I had heard that because, investors are obviously pretty bullish in general, but maybe they were referring to this as well as other kind of question marks.
Well, I think the relationship between private credit and regulation is that the reason the private credit opportunity exists is because of the regulatory pressure that banks now face that prohibits them from lending in places they normally would lend. If they're in a position that they need to build up their regulatory capital, they can't lend as freely in the markets that they normally lend in. And that's what creates the opportunity for private credit investors to come in and provide these loans. And so I think regulation has a direct correlation to the growth in private credit, but private credit is the solution to the regulatory constraint placed on banks.
Yeah, from the beginning. Yeah. I mean, you talked a lot about there's so many new entrants and it's so much more competitive than when you started. And of course, there's the other thing that people talk about a lot is that being early to a market can yield so much, you know, in terms of profits and returns. What kind of opportunities are no longer there because of all these new entrants? I mean, you talked about some of them earlier with asset allocation and why you do more of that. But.
Sure. I think as I look at other markets, right, and as I think about where we are active in credit, both traded credit, private credit, structured credit, where I see better opportunities are places where there is potentially less liquidity, there is more complexity. Where I see less opportunity is where there are more investors, more competition. And so, you know, if I had to decide to go build a business in investment grade corporates versus going into esoteric ABS, I think there is a better opportunity in esoteric ABS because it's not as well understood, there's not as much competition, whereas there's a lot of competition for investment grade corporate debt. And so I think generally speaking, as you have markets that evolve and more competition moves into different parts of the market, the benefit is they tend to bring liquidity and the markets grow. But the trade-off is the opportunity to differentiate is not as great. And so I think both asset allocation remains an opportunity in terms of recognizing alpha opportunities, but also more complex, less well understood asset classes is where we can bring to bear some expertise and generate additional return for our investors.
Yeah, which means you must be constantly on the hunt for people who understand that or who you feel like you can really teach to understand that, right?
Yes, and you know, one of the great things about the staffing model we have at the firm is that we have an analyst class that comes in each year, and we have interns, and we generally look to identify talent very early and teach these relatively young people in their career, you know, how to invest and how we think about investing, but also because they're so talented, they oftentimes come and think about different ways of looking at things, and that constant stream, and it's a bit of an apprenticeship model where, you know, and those folks, some of them end up staying for a longer period of time and getting more responsibility. It really keeps a fresh perspective on what we're doing, as well as, you know, keeping that energy and that kind of new orientation fresh in our mind.
Yeah. So apprenticeship, I mean, you can't do that over Zoom, or maybe you can, but I mean, how do you do that?
Yeah, I think you can to a point. I think you can teach someone something remotely, but I do think there is an enormous amount of value when you're early in your career to be around more senior decision makers, because I think you end up in the room more often when decisions are being made that you might not have been thought of to be invited to that Zoom if it was happening over Zoom.
Right.
I do think if I were advising myself earlier in my career and I had the choice of being remote or being in person, I would say be in person as much as possible, because you're going to absorb and just get better exposure and have more learning experiences by being around decision makers more often.
Yeah. But that means you have to really let them in the room then.
Yes.
And so you really make that a point.
We do. I mean, part of the apprenticeship model in our mind is not just asking these junior folks to do work, it's to get them to do work, but also have them have an opinion and express that opinion. Yeah. And I found that there isn't an age limit on good ideas. A lot of times it's good to hear perspectives from people that have a lot of experience and people that don't have as much experience, and then debate them pretty actively.
Private credit is so intangible in a lot of ways. I mean, obviously finance in general is, but like, what's the story that you tell some of these young people about why they should, you know, get involved in this thing which they may or may not have heard of or may not be able to imagine?
Yeah, I think it's exciting. I think it's exciting to think about all the different types of companies that you need to learn to understand. I think it's exciting to think about the puzzle, which is valuation, and it is both rewarding and very competitive that you can evaluate how you're doing on a real-time basis and see when you've made a good decision or when you haven't made a good decision. And that can be both exciting but also challenging if it's not going well.
Yeah.
But it's a constant learning opportunity where you're learning about a new company, you're learning about a new market, you're learning about a different way of looking at valuations. And I think that aspect of it, that it's an evolving market and a massive learning opportunity, is what usually excites, frankly, not just the junior people in the organization, but also the senior people in the organization.
You've been doing it a long time, so
Yes.
obviously
Yes.
it's really exciting. So like diversity of thought, you want different types of thinkers. I mean, how do you find them? I mean, what questions do you ask to try to elicit signs that they might think a little bit differently?
I think about that apprenticeship model and having access to effectively undergraduates or soon-to-be graduates. That's really the deepest pool of talent we have access to. And so that is where we have the broadest reach in terms of different types of candidates. It's a lot harder to do that if you're looking for a mid-level or senior person. Like, you just don't always end up with the same depth of candidates. And so I think as you look at various ways of thinking, as you look at various backgrounds, by going into that undergraduate community and looking at that pool of candidates, that's the place where we have the most latitude to embrace diversity in terms of the candidates that we're bringing in.
Yeah. Well, I wanted to talk about in a slightly different direction. So one of the fastest growing channels, or maybe the fastest growing channel, is retail and high net worth investors. I mean, obviously I'm with institutional investor, but that's in some ways is a saturated world. So talk about the opportunity there, but also some of the challenges or worries in investors, less sophisticated in some cases, kind of going into this.
Sure. So as we think about the investor landscape, 50, 75 years ago, investors generally had defined benefit pension plans that were managed by institutional investors. A lot of those pools still exist, but over the last 25 years, it's been much more 401ks, defined contribution, personally controlled pools of capital, which means a lot more of the saving asset base has shifted into the hands of retail investors. And if you look at that pool, I think it's something around 12 trillion of assets that sit in 401ks. They have been invested in generally daily liquidity mutual funds, bond-focused, equity-focused mutual funds. They have a very long horizon, right? These could be 30, 40, 50-year horizon investors. They really should, and I think they're starting to look at allocations to alternative assets. And so from an opportunity standpoint, as an alternative manager, there's this huge shift that should be happening in the coming 5, 10, 15 years, where retail investors are allocating more to alternative assets. Now, that does present some challenges. One challenge is just information, right? Part of the reason alternatives exist is because it was really designed to be a product that went outside the scope of the 40 Act. And so you have to think about designing products that work for that investor base, but also the way that you communicate with that investor base and ensuring that that investor base understands what they're buying is really important.
Right.
And so, I would say, we think it is an opportunity. We think there is an investor base there, that we have products that can help, but you have to make sure it's done in a way that those investors understand what they're buying, they appreciate the risks of it, and
the illiquidity. They can't get their money.
Exactly.
Over a period of time. Like, I could see them being incorporated in some kind of target date like vehicle, or so that they're not necessarily just choosing, or with an advisor, right? That it can be coupled with something else.
Yes. I mean, typically for that investor base, the way the business sets up is there are multiple intermediaries that could stand between, the portfolio manager of that strategy and the end investor. And so you need to make sure that those intermediaries are accurately reflecting both the benefits that this brings to their portfolio, as well as the structure of the investment and all the whatever constraints may exist, liquidity, fees, all those things are appropriately disclosed.
Yeah. Have you thought about new models of like what you might not do for a retail or high net worth investor that you would do for an institution, or new structures? I mean, when you think about like that blank piece of paper, have you kind of thought about, ideas?
We have. We, as a firm, I think are less likely to be the first to present a new product for retail investors.
Right. But just in
given some of the
general,
constraints.
for others too.
But we have thought about that. I think we've been very innovative in the products that we do with institutional investors. The difference there is we're having a bilateral conversation with those investors and telling them exactly what they're getting and exactly how it works. And there is a depth in that relationship that, going back to the long-term orientation, a lot of times these investors are investors we've had for, decade, 2 decades. And so there is a level of communication and transparency there that, can't exist when you're talking about mass affluent retail, for example.
Yeah.
And so I think we're absolutely willing to be innovative to make sure that our investors are getting what they want and that we're working together on a partnership basis. I think with retail investors, it's more likely to be, okay, here's a product, you can decide if you're interested in it, as opposed to customizing.
Back to institutional investors. Talk about the questions that you're hearing the most often these days. What are they thinking about? And maybe that's different by the type, but...
Sure. We get a lot of questions about macro. And one of the things that has been very helpful as an investor at Bain Capital is about 5 years ago, we created a macro group at Bain Capital. So we obviously always had access to multiple sources of macro research, but we didn't have an internal group dedicated to it. And we created an internal group that sits across the different business units and consumes and creates their macro view. But what's really interesting about it is they also have access to management teams in the private parts of our portfolio to check their theses on what's happening real time. Because a lot of the challenges sometimes with macro is information comes in on a lagged basis. And so having this group exist where they can call executives in portfolio group companies, check their theses, understand what's happening with the supply chain, what's happening with labor pressure. And then when they report to folks like us on the public side, we don't need to know the specific companies or the specifics of their conversations on the private side, but we're able to benefit from them having real-time checks on what their view is. And our group has been fantastic in terms of being very early and seeing where the economy's been going really since COVID and thereafter. And so as someone who goes out and speaks to investors, having this macro view, not only from an investor standpoint and being able to reflect how we think about it in the portfolio, but also having that real-time view has been really helpful. So I'd say macro is one of the most common things we get questions about. And then more broadly across credit, there is always this moving temperature around private credit is great. Everyone wants to talk about it, and that won't last very long. And everyone says, okay, now we're worried about private credit. What's happening in private credit?
It's going back and forth.
Yeah, I think on the broadly syndicated side, we get a lot of questions about leveraged loans and some of the bankruptcy, lender-on-lender violence situations, liability management situations that have been happening and what that means for recovery rates and how to manage that. So I like to say as credit investors, we always have things to worry about, and our investors similarly have a lot of things that they ask us about and that they may be worried about, but that's a big part of thinking about risk management.
Yeah, lender-on-lender violence. I do love that term, right? It's just so colorful. Speaking of color, when you look back, what are some of the most exciting deals that you've worked on or times that you've been, in this business?
Sure. Operating in credit means that oftentimes some of the best opportunities that you see are the result of volatility on the way in. You're oftentimes trying to manage assets that are falling in price with what are also some really compelling opportunities. And so as I look at my career, of course, now 15 years later, I can look back and say this, but the financial crisis certainly was a time where there was a lot of really interesting and great, valuable learning lessons that have informed the way I think about investing. That wasn't always the most fun at the time,
right?
But that was definitely one of the most exciting times. And even going back and looking through COVID, for all the terrible things happening in healthcare and the horror of being locked up and working remotely, at the same time, there's a very interesting question of what was happening in the economy, what was happening in markets, what was the investment opportunity. And so, it's a bit of a dark thing to say, but sometimes I think the most exciting times are crises. The other thing I would say is when we develop something new or get into a new market, that's always really interesting.
Yeah.
And we've had experiences with that in the past, but I'd say that's just a different, maybe less macro-centric time of excitement.
Right. I can see exactly why it is really exciting, but how do you balance the scary with, this is an opportunity? I mean, it really is so much easier said than done, right? Like, don't hire me because I would never be able to get over that, fear.
I will quote Jonathan Levine, a friend of yours, who would say, it's never as good as you think or as bad as it feels.
Yeah.
And it's actually a very accurate way of going back to that when one, things seem like everything's going really well, and just to think like this isn't going to last forever. We got to be thinking about what might be the thing that sets us off course, or how do we make sure we haven't lost discipline on our investing strategy, and just keeping sharp in times when everything seems fine, but also when things aren't fine, that you have to be rational about it and you have to think about outcomes. You can't just be emotionally reactive to the environment. And so it's not as bad as it feels. It feels bad if prices are falling and you feel responsible for this. But if you're rational about it, you're going to make a much better decision. And I think that's a great phrase to keep in mind, both in good times and in bad, to maintain discipline and to make sure you're making good decisions for your investors.
Yeah. You know, you talked about mentors earlier on, and you talked about apprenticeships. You know, maybe you can talk about your own mentors, or how, you know, you really mentor now, and the diversity, right? Like getting diverse thinkers and from diverse backgrounds, all of that, because I think that people really are spending a lot of time, you know, on that, and it's not always so rational, or maybe it is.
Yeah, I look at my own career, and I'm very grateful for having had some fantastic mentors along the way. And it's something that you don't always fully appreciate in the moment, but you realize after the fact how impactful it's been. And if I could be half the mentor I've had in a few different stages of my career, I feel like I will have done my part in terms of paying it forward. But on the point of diversity and thinking about that apprenticeship model, you know, I think it's really important to make sure that you take the time. And the challenge with mentorship is, you know, if you think about the world in the matrix of urgent and important, right? There are a lot of things that are urgent and important, and those things get focused right away. Right. There are a lot of things that are urgent and unimportant. Like mentorship, in my mind, is never urgent, but it's very important. And so you just have to make sure that you take the time with the talent that you have to say it's worth investing in these people and help them understand the opportunity that they have, and make sure that you're trying to bring them along. And I think that goes back to the private partnership and the long-term view on, yes, investments, but also talent. And then making sure you tap people at the right time to say, you realize you've gone from being a mentee to now you need to be a mentor. That happens oftentimes earlier than people recognize they're ready for. But that actually is a good opportunity to say, hey, look, I see you as being at a point now that you can be a mentor to this person. And you know, I think it's something that the more it exists, the more it gets reinforced in the next generation of leaders that you have on the way up.
Right. Well, great. Thank you so much for doing this.
Thank you for
really
having me.
Great.
No, I really appreciate it. It's been great.
Thank you. Thanks for listening. I'm your host, Julie Segal. A Conversation with Julie Segal is produced by Deanna Chapman. And always check out institutionalinvestor.com for more.